I'm expecting the summer to be a strong summer for the markets, and I still have a 7,000 target. I changed my target back in January from a 6 to 7,000 range, and just dropped the bottom of the range and said we're going to 7,000. It has been a narrow advance compared to what a healthy market should be. But I think it's about to broaden out. What I see going forward is that you're going to see a much broader market, with the Russell probably outperforming all the other three major averages into the top. My target on the Russell is 3,300.
This is essentially a melt up before the big crash, the end of the 42-year secular bull markets in equities. Any surprises since the last time? Things going as expected for you? Any surprises? Any reason to change your thesis at this point?
I don't think so. If anything, I think things are coming my way. The trader type investor gets nervous every time this thing pauses, and you've got to go through those consolidations to build the wall worry and allow for fuel to build up the fuel for further advances. So I don't see anything out of the ordinary in terms of any pauses we've seen. Certainly we had that pause back in March, April that had a lot of people turn much more negative. And then we've gone on to new highs, and we've had a short pause here. I wouldn't be surprised, given what we're seeing in the NASDAQ and the tech side, and particularly semiconductors. I wouldn't be surprised if we've got a little bit more to go here. Might be 3 or 4% in the NASDAQ, and maybe 1 to 3% in the S&P and the Dow, and maybe even less than that in the Russell. I think the Russell's looking like it's almost done with its consolidation, and it's certainly lagged the market. So I'm expecting the summer to be a strong summer for the markets, and I still have a 7,000 target. I changed my target back in January from a 6 to 7,000 range, and just dropped the bottom of the range and said we're going to 7,000. And I've said, I think, if anything, I'm too conservative.
Has the consolidation of value surprised you at all? And when we talk about the market, it's almost like we're really just down to 5 companies that are driving this right now. And, the NVIDIA valuation drives some people crazy. They can't understand it. There's a lot behind a valuation of a public company, mainly sentiment, but also they control about 80% of the world's AI-based semiconductor. There's maybe a case there for that valuation if you believe wholeheartedly in the AI boom. But what's your take on that?
Yeah, certainly NVIDIA and the so-called Mag 7 earlier in the year were strong performers. But I have always pushed back on the narrative that that's what's the entire market. I think I heard this week that there's something like 125 out of the 500 S&P stocks are outperforming the S&P. So, and if you look at industrials, you look at some of the home builders, for example, you've had several groups that have performed magnificently. Look at Costco. I mean, for heaven's sakes, on a stock, it looks like NVIDIA. So, there's been a lot more than the Mag 7. People get into these narratives, and they're partially true, but there's a lot of falsehoods behind them as well. So it's been a narrow. I'm not questioning it's been a narrow advance compared to what a healthy market should be. But I think it's about to broaden out. What I see going forward is that you're going to see a much broader market, with the Russell probably outperforming all the other three major averages into the top. My target on the Russell is 3,300. So from here, you're talking about 65% advance, with maybe the NASDAQ and the S&P having half of that or less. So I think you are going to see a much broader rally into the top. It's been slow coming, but I still think that's going to happen. That does not mean NVIDIA is done, or that the tech rally is done, or semiconductors are done. I think they will continue to participate and maybe even lead into the top, but there's going to be a much broader leadership, I think.
Right. Now, how do you play that personally, David? Do you have skin in the game in that rally, or are you backed off on the sidelines looking for other opportunities?
Yeah, I definitely. I don't talk about my own trading at all, because I got to be careful it doesn't get interpreted as some sort of advice, but I will say I certainly have skin in the game. I put my money where my mouth is, and I do believe there's, as I keep saying, it's a very unique period where I'm talking about 30 to 60% upside in the market, and yet saying that could all happen this year. And so you're coming to the end of a 42-year secular bull market. And so normally I'd be saying, don't be so cute that you think you can call the top and get out right at the top, because that's not reality typically for most investors. On the other hand, there's such a long runway from here to the top in terms of the magnitude of the rally that I think you don't want to jump out too soon, because you're probably going to be forced back in. If you get out early here, and then all of a sudden see the Russell has more than 50% upside, and it's going gangbusters, you're going to change your narrative and say, hey, there's a lot more to run. You may even think it's got years to run. I don't believe it does, but I think the magnitude of the rally is what you would normally get in a matter of 2 or 3 years.
What you expect from a Fed policy standpoint, over maybe that same time frame, next 2 quarters or 3 quarters, especially with an election coming up. Any thoughts on that?
I don't think they're election driven. I mean, Yellen's probably talking to Powell and saying you could, be nice if you could help us out a little bit. But I think Powell is a straight shooter, and I think the FOMC are basically, their members are basically trying to be as non-political as possible. What I believe is that we went through the first quarter where it looked like inflation might be pushing back up, and that we might have gotten all we're going to get for a while in terms of the bringing inflation down. And what we've seen in the last month or two is it going the other way, and maybe it looked more like January in particular was an aberration or just kind of a stair-step backwards. I believe going forward, inflation is going to be good news, not bad news, that we are moving further down. I think the consumer is showing signs of deceleration. So I think the economy is decelerating. Inflation's likely to decelerate from here through the balance of this year. And that means I think the Fed's going to come the other way again and say, maybe we can do rate cuts. So I would not be shocked to see a rate cut at the July meeting, which I think is the end of July. And if not, then certainly in the September meeting. So I'm of the belief we'll see 2 or 3 cuts this year. And if things really decelerate, you could see more than that. But my guess is it's limited somewhat, because I also have this bullish view on where the indexes are going. If Powell looks and sees the S&P anywhere near 7,000, I just don't think he's going to be in a mood to cut further. So you might get the first cut and stop, or you might get 2 cuts and stop. I don't think he's going to feel compelled, even if the economy is decelerating, if the market's that high, to say, hey, we need to give it more. So, Bill Dudley's thesis of back in spring of 2022, when he talked about financial conditions are very much influenced by the stock market, and how, at that time he was talking about the stock market having to, be pushed a lot lower. Powell bought into that. Now he's since then seemingly ignored the market to some extent, but I think it's still in the back of his mind that, yes, stock market being healthy is okay, but if it's running away, maybe that's inflationary, and maybe we have to counter that. So I don't think it's going to be clear sailing in terms of rate cuts, but I do think you could get a couple of them here. What I have said consistently is, although I think the Fed could cut here, my thesis doesn't depend on that, because the bond market's going to take rates down either way. So, whether the Fed cuts or not, it's really the bond market that's going to determine rates, as it always does. And I think rates are going lower. I think we're going to see a sub 3%, and I think actually a 2.5% 10-year this year.
Could I make the assumption then that prediction for energy prices is also down?
Yeah, that's definitely been my thesis, is that we're heading towards 60 on oil. We got down into the low 70s, or maybe into the high 60s, and it turned around here. And now all of a sudden you got the voices coming back saying, hey, we're going back towards 100 or back over 90. I don't think so. Anything's possible, but I think more likely this is just one of those stair steps counter trend rallies. And I still think oil rolls over here and heads lower, partly because I think the global economy is softening. Yeah, believe it or not, I'm very bullish gold near term. I mean, I think you can see 3,000 has been my target for a long time, but I think we can see 3,000 this year. I think you can see 60 on silver, and I've said if it gets to 60, it may push through and go to 75. So those are big runs, and I think what we've had in the last month or 5 or 6 weeks of consolidation, I think is setting us up very soon for a big rally. And so I think we have a strong summer in the metals. The miners, which have lagged, I think will finally start catching up too. As I say, for people, and so many new investors come in and they treat investing like gambling. And I go, buying low and selling high doesn't mean it has to happen in the next 3 months,
Exactly. Yeah. You can sit in a position for years before you get that action, and which really comes into the strategy behind it all. I mean, at the beginning of this, you were just talking about like the trader type mentality, looking at the short-term fluctuations in the equities markets and making grand assumptions about what those short-term fluctuations may mean, when in reality, it's just that nothing goes up or down in a straight line. There's volatility in both directions, but you want to look at the bigger trend. Yeah.
Yep. And as I say to my followers a lot of times, the market loves you guys. It loves to take people who fall for those moves and draw a big conclusion from them. That's exactly what those consolidations are for. They're there to make you nervous, to build that wall of worry back. And if you react to it, you're basically playing right into the market's hands. Yeah, having done this for 50 years, I can say, the longer I'm in it, or the more recent times, so many investors are not investors, they're traders. I mean, I don't know what the mindset change was. Maybe it's computers and having all kinds of programs that you can look at on a short-term basis. But I find so many retail people who have no idea what they're doing think everything's supposed to happen fast. Yeah, I really believe, and it hasn't come to fruition yet, but I really believe we're staring at a very weak dollar ahead. It's hung up, it's hung in here. It started to break, I don't know when that was, a year ago, and then turned around and had this very long counter-trend rally where it's gone up, come down some, and gone up again. I really think we have a weak dollar ahead. The problem is Japan's been stubborn in terms of changing their policy, but I think it's a matter of time for them. I mean, they're defying logic in terms of printing money like crazy and being able to keep interest rates close to zero. That's just not, we saw what happened here in 2022. When it breaks fast. And I think Japan's very close to a reversal in the yen. So not by choice, but I think rates are going to start pushing up there. My read of the euro is that the euro is going to rally. Canadian dollar, Australian dollar look poised for rally. So I think the dollar is going to come under pressure. Part of it is going to be, I think, that our interest rates come down faster than some other places. Whether it's Fed induced or whether it's just our economy is going to start decelerating pretty fast. I'm not sure yet, but I think that's all playing into, weak dollar obviously will help gold quite a bit. Lower interest rates, I think, may seem somewhat opposite to intuition, but I think lower rates helps gold. So I think you got both of those coming here. And at the same time, you still do have plenty of things around the world to get those that want to look at gold as a safety or a place to run. You got the geopolitics out there that is going to add to that. You've got central banks, particularly China and Russia, buying up gold, looking to back their currencies perhaps. So you've got I think there are a lot of cross currents out there that are going to help gold, but more than anything else, technically, gold broke out, as got above that 4 tries at 2100 or wherever it was, broke out. and had a nice run, and then has consolidated for a couple months at a high level. And I think it's ready to break out again, or get out of that consolidation. I think the next run is probably going to be right to 3,000. So I think both technically and fundamentally, it's got support here, and there's been in both gold and silver, you've had very little institutional sponsorship, and if they start performing here, they're pretty thin markets, or not very big markets, particularly on the minor side. That if institutions decide they need to have 5% of that in their portfolio, and they start copying one another, it doesn't take much to drive these prices up. Yeah, I think certainly poor man's gold is a big part of it, but it also is a metal that's in strong demand and not very good supply. And as you know, I mean, it's not easy. Neither gold or silver is easy to find anymore. So, once you start seeing that tight supply demand situation, it's a long process before you can get that supply worked out. So, I think it's got both fundamentals going forward and just the fact that it is poor man's gold.
Okay. Now, quick question on the dollar there, just to back up a minute. Were you surprised when Saudi Arabia decided not to renew the petrodollar agreement? Were you surprised that it didn't get more media attention than it did? Do you think it's a significant event, or is it more of an abstraction because they could already sell oil in other currencies should they want to?
I'm not all that close to it. What I have seen was that it's not even a sure thing. I assumed it was a sure thing, and then I saw some commentary where that's what Russia's been reporting, but that it hasn't been confirmed. So I'm not even sure that it's actually taken place. You may know better than I do that because I'm not that close to it. But my thing is, I guess I'm not overly surprised because the Biden administration has not had good relations with the Saudis, and certainly has not shown any inclination to help their problems. And Saudi's been talking about getting closer to China and doing things in other currencies. So not totally surprised. I'm a little surprised in that we were such a backer militarily to them, and and certainly under Trump, the Abraham Accords and everything, there was a good relationship with the Saudis. So I guess my attitude would be, if Trump gets back into office, I think that relationship can be repaired. I don't think it's a sign that's long-term broken, but the Saudis may be just saying right now, you guys aren't doing us any favors.